Welcome to Breaking News to Trading Moves.
It's good to be here.
We have a very specific focus for our discussion today. We're zooming in on a single corporate action that recently hit the wires.
Hmm.
It involves a brand that I think pretty much everyone listening has likely owned or at least, used at some point.
It's one of those brands that's just everywhere. You can't walk through an airport terminal, I mean, anywhere on the planet, JFK, Heathrow, Haneda, without seeing it rolling past you.
Exactly. We are talking about Samsonite, the luggage giant.
The world's largest travel luggage company, to be specific.
But we're not here to talk about the durability of their suitcases or their new spinner wheels. We're here to talk about the stock.
Right.
Specifically, the news that Samsonite, which is currently listed in Hong Kong, is pursuing a dual listing on a United States exchange.
That is the headline event. Samsonite International SA is looking to establish a foothold in the U.S. equity markets.
So the mission for today is clear. We're going to take that headline and really look at it from all angles. We need to understand the mechanics of what they're proposing, why they're doing it, and, most importantly for our listeners, who makes money on this?
Who are the winners?
Who are the winners in the market infrastructure? And conversely, who might face some headwinds because of this move?
That's the goal. Moving from the news alert itself to the actual trading implications.
Yeah.
Because a move like this, it doesn't happen in a vacuum. It involves banks, exchanges.
Custodians, competitors.
It changes the flows of capital.
Let's start at the top then. The structure of the deal itself. When we say dual listing, what does that actually mean for Samsonite? Are they packing up their bags in Hong Kong and leaving?
No, and that is a crucial distinction. This is not a delisting from Hong Kong.
Okay.
They're not abandoning their primary listing. Instead, they're looking to create a secondary listing.
Yeah.
Think of it as opening a second storefront. They have their main shop in Hong Kong.
Where they've been for years.
For years. Now, they want to open a branch in New York.
Okay, so they keep the Hong Kong ticker, but they add a U.S. ticker.
Precisely. And the mechanism they're using to do this is something called American Depository Shares, or ADS.
We hear that acronym a lot, ADS, or sometimes ADR. Let's pause here for a second and explain what that actually is, because it's not quite the same as just issuing a normal share of stock, right?
It's slightly different technically, though. For the average trader, it functions in a very similar way. An American Depository Share is essentially a certificate.
A certificate.
A certificate that represents a specified number of shares in a foreign company. The actual shares, the legal ownership units, they remain in the home market. In this case, likely held by a custodian bank in Hong Kong. The ADS is the receipt that trades on the NYSE or Nasdaq.
So it's kind of like a claim check.
That's a great analogy. The actual share is in the cloakroom. The ADS is the ticket you hold in your hand. You can trade that ticket with someone else, and whoever holds it has the right to the coat. But you don't have to go all the way to the cloakroom to trade it. You can do it right there on the floor.
That makes perfect sense. It bridges the gap between the two markets. Now, let's look at the size of this specific proposal. How big of a slice of the company are they talking about offering to U.S. investors?
The filing indicates a global offering of these American Depository Shares, representing up to 9.97% of their total issued shares.
9.97%. That is incredibly specific. Basically just shy of 10%.
Right. It's a substantial block, but, it's not a controlling stake. It's enough to create real liquidity.
Right.
Enough to get the attention of major U.S. institutional investors.
But not enough to change the whole control structure.
Exactly.
Not overnight.
Now, here's a detail that jumped out at me in the filing, and I want to get your take on it. The pricing. The material says the issue price would be no more than a 15% discount to the last closing price before the underwriting agreement is signed.
Yes. That definitely caught a lot of eyes. A 15% discount. If I see a 15% discount sign at a store, I think, great deal. But if I'm a shareholder and I see the company selling equity at 15% below the market price, I might get a little nervous. Why such a steep potential discount?
It does sound steep. I get that if you think about it in retail terms. But you have to view it through the lens of an institutional capital raise.
Okay.
When you're trying to move nearly 10% of a company into a brand new market, you need to incentivize the buyers. You're asking big funds to step up and take a large position. The discount acts as a buffer.
A buffer against volatility. It creates a margin of safety for the people buying in.
Exactly. And frankly, it's a maximum discount. It just sets a parameter. It doesn't mean they'll actually price it there. It gives the underwriters flexibility to find a clearing price where demand meets supply.
So if demand is really hot.
The discount might be much, much smaller. But
Yeah.
they need that 15% ceiling or floor, depending on how you look at it, to ensure they can get the deal done, even if the market gets a little choppy.
Okay, that clarifies it. It's the cost of doing business to open that new storefront. So, assuming this goes through, Samsonite raises a pile of cash. What are they going to do with it? What's the use of proceeds?
They've outlined 4 main buckets for this capital. They're fairly standard, but they tell us a bit about the company's mindset. The first is simply general corporate purposes and operations.
Keeping the lights on, the boring stuff.
Essential, but yeah, boring. The second is CapEx, or capital expenditures.
So, investing back in the business, what does CapEx even look like for Samsonite?
It could be upgrading manufacturing facilities, investing in new molds for hard-shell cases, or, improving their logistics and distribution network. Luggage is a physical business,
Gotta make the stuff and move the stuff.
and that takes capital.
Okay. Bucket number 3,
Debt repayment,
cleaning up the balance sheet.
always a prudent move, especially in a higher interest rate environment. If they can swap some equity for debt, they lower their interest expense and improve their credit profile. It makes the company more resilient.
And the 4th bucket, this is usually the one that gets traders excited.
Potential acquisitions.
M&A, mergers and acquisitions.
They explicitly mention it as a potential use of funds. And Samsonite has a history of growing through acquisition. I mean, they own Tumi, they own American Tourister. This capital gives them the firepower to go shopping if they see a smaller brand that fits their portfolio.
So this dual listing isn't just a branding exercise, it's a war chest. They're reloading the bank account for whatever
Yeah,
comes next.
Precisely. It provides optionality.
Before we move on to the why, let's just check the status. Is this a done deal? Can I go buy the ticker today?
Not yet. The timing and structure are still to be determined. And crucially, this is subject to shareholder approval. The existing shareholders in Hong Kong have to vote on this.
So it's still just a proposal.
A plan, but not yet a reality.
Okay, so that's the what. Now let's talk about the why. Why go through all this trouble? Why deal with U.S. regulators, the SEC, the lawyers, the bankers? Why not just stay in Hong Kong?
The company has given us 2 primary reasons: visibility and liquidity. But we should probably break those down because they mean specific things in this context.
Let's start with visibility. Samsonite is already famous. I mean, why do they need more visibility?
You have to distinguish between brand visibility and investor visibility.
Ah, okay.
Yes, everyone knows the suitcase. But not every portfolio manager in New York or Boston spends their time looking at the Hong Kong Stock Exchange.
They stay in their lane.
Exactly. Many U.S. funds have mandates that restrict them to domestic listings, or they just prefer the regulatory comfort of the U.S. market. By listing in the U.S., Samsonite puts itself on the radar of the largest pool of equity capital in the world.
It's about getting in front of the people managing hundreds of billions of dollars.
Oh, yes. Expanding the audience. And that leads directly to the second point, liquidity. The U.S. markets are incredibly deep. The trading volumes in New York often dwarf other exchanges. By accessing that liquidity, Samsonite hopes to dampen volatility and maybe, over time, achieve a better valuation.
That's the subtext here, isn't it? Valuation. We often see that U.S.-listed consumer companies trade at higher multiples, higher price-to-earnings ratios than their counterparts elsewhere.
That is the valuation gap arbitrage. If Samsonite trades at, say, 12 times earnings in Hong Kong, but its peers in the U.S. trade at 18 or 20 times earnings,
then simply adding a listing could theoretically unlock that value.
they're betting that U.S. investors will pay more for the same dollar of earnings than Hong Kong investors will.
It's financial engineering 101. Change the zip code, change the price tag.
In a nutshell, yes. It also broadens the shareholder base. You're less reliant on the sentiment of just one region. If Asia is having a tough economic year, but the U.S. is booming, having access to U.S. investors helps stabilize your stock price.
Diversifying your funding sources.
Correct. And there's a signal being sent here too, right? Even before the first share is traded.
How so?
Oh, absolutely.
Oh,
The announcement itself is a signal. It signals confidence. It says, we are ready for the scrutiny of the U.S. markets. It signals that the company is in deal mode.
it gets people talking.
It lists sentiment. For investors who track capital markets activity, people who bet on IPOs, secondaries, and deal flow, this is a green light. It shows that the machinery of cross-border listings is active and working.
So that sets the stage. We have a major global brand currently trading in Asia, trying to unlock value in cash by selling about 10% of itself to Wall Street. Now, let's get to the part that I think is most valuable for our listeners. Let's break down the winners and the losers.
Okay.
Who benefits from this specific transaction?
We've identified 3 distinct groups of winners. And when we say winners, we mean companies whose business models directly benefit from this kind of activity.
All right, let's start with group one, the venues themselves, the U.S. exchanges and market infrastructure.
This is the most direct correlation. If you run a stock exchange, your product is listings. You want companies to list on your board.
It's like a landlord wanting tenants.
Exactly.
Yeah.
And Samsonite is a marquee tenant. If they list in the U.S., they have to pay listing fees. That's recurring revenue for the exchange.
But it's not just the rent, is it?
Oh, no, the rent is just the start. Think about what happens when a stock trades. You need market data. Traders, algorithms, hedge funds, they all pay the exchanges for the real-time price feeds.
And the more popular the company,
The more valuable your data feed becomes. And the trading volume itself. Every time a share changes hands, the exchange collects a tiny fee, a fraction of a penny. But when you're talking about millions of shares, that adds up very quickly.
and a name like Samsonite will probably attract a lot of retail interest.
High retail interest, active trading.
Yeah.
That is volume. And volume is revenue.
You also mentioned this idea of the IPO pipeline tailwind.
Right. The exchanges, specifically the NYSE and Nasdaq, are in a constant battle for global supremacy. They want to show the world that they are the destination for global companies.
So this is a case study.
It's a case study. If Samsonite has a successful dual listing, the exchange can go to other companies in Asia or Europe and say, look at Samsonite. They did it, and it worked. You should come too. It's a marketing tool for the next deal. It keeps the flywheel spinning.
So who are the specific tickers we're talking about here? We have 2 main players in the U.S.
The duopoly. First, we have the Intercontinental Exchange,
Ticker ICE.
ICE. They are the parent company of the New York Stock Exchange. They are the old guard, the home of the blue chips.
And the other one?
Nasdaq, ticker NDAQ.
NDAQ.
These 2 companies are the toll booth operators of the U.S. equity market. Any new car on the highway pays a toll to one of them. Samsonite is a new car.
Okay, group 1 is the toll booth operators. Let's move to group 2, the people who actually build the on-ramp, the investment banks and capital markets underwriters.
The facilitators. You can't just walk into the stock exchange and say, here are my shares. You need intermediaries. You need underwriters.
How does the math work for them? We talked about that 15% discount earlier. Is that where they make their money?
That's part of it, the spread. The banks buy the shares from the company at a set price, and they sell them to the public at a slightly higher price. That difference is their gross spread on a deal of this size.
A deal representing 10% of a multi-billion-dollar company.
That fee pool is substantial. We're talking tens of millions, potentially.
For a few weeks of work.
A few weeks of intense work. But it's not just the one-time fee. It's the relationship. We touched on this with the use of proceeds.
Right. You mentioned M&A and debt repayment.
If Samsonite raises this money and then decides to buy a competitor, who are they going to call for advice?
The bank that just handled their listing.
Exactly. If they need to issue bonds to refinance debt, who gets the call? The bank that knows their books inside and out. The listing is the event that anchors the relationship for years of future advisory fees.
So for the banks, there's a broader signal here too.
Yes. It implies an improving risk appetite. Banks make the most money when markets are risk-on. When companies are issuing equity, it means they're confident. When investors are buying that equity, it means they're confident. If Samsonite pulls this off, it encourages other bankers to pitch similar deals to their clients. It shows the window is open.
So who are the heavyweights here? Who are the tickers we should be watching?
We are looking at the global leaders in equity capital markets.
Goldman Sachs, ticker GS.
GS. They are almost always involved in these top-tier cross-border transactions.
And Morgan Stanley, ticker MS.
MS, another absolute titan in this space. These firms have the global distribution networks to place these shares with investors in London, New York, and Hong Kong simultaneously.
Okay. Exchanges, banks. Now let's go to group 3. This is the one that I think most people might overlook. The plumbing, ADR, custody, and cross-border servicing.
This is the back office, the infrastructure that makes the whole magic trick work.
We used the coat check analogy earlier, so this is the bank that actually holds the coat.
Right. Someone has to physically or electronically safeguard those shares in Hong Kong. That's the custodian.
Yeah.
And someone has to issue the receipt in New York. That's the depository bank. And they don't do this for free.
I'm sure they don't.
There are fees attached to every step. Issuance fees when the ADS is created. Cancellation fees if an investor wants to convert back to the Hong Kong share. Sometimes there are even annual custody fees.
It sounds like a lot of small fees.
It is. But it's a volume game. If you're the custodian for thousands of programs like this, Those small fees aggregate into a massive, steady revenue stream. It's very sticky revenue.
See how.
Well, once you are the depository bank for a company like Samsonite, it's very rare for them to switch. You have that business for the long haul. And unlike trading fees, which rely on volatility, custody fees are generally based on assets under custody. It's a stable baseline.
So who are the kings of this plumbing?
Two names really dominate this specific niche of American depository receipts.
Bank of New York Mellon, ticker BK.
BK. This is their bread and butter. They're the oldest bank in America, and they specialize in trust and custody banking.
And the other one is JP Morgan Chase, ticker JPM.
JPM. Well, they're known for everything from credit cards to investment banking. Their custody and securities services division is an absolute juggernaut.
So if you believe in the trend of more cross-border listings, more global companies seeking U.S. liquidity, these are the picks and shovels plays.
Exactly. They own the infrastructure.
Okay. We have covered the winners, the exchanges, the bankers, the plumbers. But markets are often a zero-sum game. Every action has a reaction. Let's talk about the losers. Who faces headwinds here?
We have identified three groups that might see some pressure. And again, when we say losers, we don't mean they are going out of business. We just mean they face a comparative disadvantage or a headwind because of this news.
Okay, let's start with group one. The Hong Kong liquidity proxies.
The funds that track the Hong Kong market specifically.
Why does this hurt them? Samsonite is still listed in Hong Kong. It's still in the index.
True, but think about liquidity. Think about volume. If a major U.S. pension fund wants to buy Samsonite and suddenly there's a U.S. listing, which one are they going to buy?
The U.S. listing. It's easier.
It's easier. It trades in their time zone. It settles in dollars. The volume gradually migrates from Hong Kong to New York. Over time, the Hong Kong line might become less liquid. It might have wider bid-ask spreads.
And for an ETF that tracks Hong Kong, that's just friction.
It creates friction. And more broadly, it's a sentiment hit. If the best way to trade the best companies in Hong Kong is actually in New York, it diminishes the allure of the Hong Kong exchange itself. It dilutes the focus.
So who are the proxies here?
The major ETFs. The iShares MSCI Hong Kong ETF, for one.
Ticker EWH.
EWH. This is the standard way for U.S. investors to bet on Hong Kong.
And the Franklin FTSE Hong Kong ETF. Ticker FLHK.
FLHK. A similar product. These funds rely on the Hong Kong ecosystem being vibrant. If liquidity leaks out to New York, it's a marginal negative for them.
Group 2. This one's a little less obvious. The competitors. Travel accessories and premium bag peers.
The other bag makers.
Why is this bad for them? Shouldn't a booming luggage market lift all boats?
In theory, yes.
Yeah.
But in the stock market, capital is finite. Portfolio managers have a limited budget for each sector.
Right.
If I decide I want to allocate, say, 2% of my portfolio to the travel recovery theme, I have to pick the best stock. And Samsonite just made case for being the best stock.
They're the biggest, and now with the U.S. listing, they're the most accessible and liquid.
So if I was previously holding a smaller peer because it was the only option in New York, I might sell that peer to buy Samsonite. It's the shiny new object syndrome. It sucks the oxygen out of the room.
So who are the runners-up that might feel this pressure?
Well, we can look at a couple of names in the handbag and accessory space that overlap with the travel theme.
Vera Bradley, ticker VRA.
VRA. They're much smaller, known for their patterned bags. They play in the travel accessories market, but they are a niche player compared to Samsonite.
And Tapestry, ticker TPR.
TPR. This is a bigger company. They own Coach and Kate Spade. But again, if you're looking for a pure-play travel stock, Samsonite is a cleaner bet than a fashion house that also happens to sell suitcases.
So it creates a direct competitor for those investment dollars.
It does.
Finally, Group 3, China and Hong Kong heavy consumer discretionary baskets.
The regional consumer ETFs.
Explain the logic here. This sounds like what you might call the substitution effect.
That's exactly what it is. Previously, if a global investor wanted exposure to the Chinese consumer or the Asian travel rebound, they often had to buy a broad basket. They would buy an ETF that held Alibaba, Tencent, Meituan, and Samsonite.
They bought the haystack to find the needle.
Right, but now the needle is available for sale separately in a nice package right on the NYSE.
So they don't need the haystack anymore.
Or at least they need it less. If I can express my view on the Asian traveler by just buying Samsonite directly in New York, I might reduce my exposure to the broad ETF that holds a lot of other stuff I don't necessarily want. It allows for sniper targeting instead of shotgun targeting.
It reduces the structural demand for those broad baskets.
Correct.
So what are the tickers for these
And
baskets?
the big ones tracking this theme. There's the Global X China Consumer ETF,
Ticker CHIQ.
CHIQ, and the iShares China Large Cap ETF,
Ticker FXI.
FXI. Both of these could see marginal outflows if investors decide to swap the basket for the single stock.
It's remarkable how one decision by a board of directors in Luxembourg, of all places, since that's where Samsonite is incorporated, can set off this chain reaction.
That's the interconnected nature of modern markets. A listing decision touches legal structures, banking fees, trading algorithms, and comparative valuations across borders. It's never just about one company. It's about the entire ecosystem.
So let's wrap this up. Let's synthesize what we've learned today.
The core takeaway is this. Samsonite is making a strategic play to leverage the U.S. capital markets. They want the liquidity, they want the visibility, and, well, they want the valuation premium that often comes with a New York ticker.
And to do that, they're willing to issue new shares, potentially at a discount, to get the deal done.
Correct.
The winners are the infrastructure players, the U.S. exchanges, that's ICE and NDAQ, who get the listing and the data fees, the investment banks GS and MS, who get the underwriting fees, and the advisory relationship.
And the custodian banks, BK and JPM, who run the plumbing behind the scenes, they're the toll collectors on this new bridge.
And on the flip side, the entities that face headwinds are the ones that lose relative attention. The Hong Kong liquidity proxies EWH, FLHK, who might see volume drain away.
The industry peers, VRA and TPR, who have to compete with a shiny new rival for investor capital. And the regional baskets, CHIQ and FXI, who might suffer from that substitution effect.
It creates a new set of relative value trades. For a trader, that is where the opportunity lies.
Understanding that flow of funds. At the end of the day, liquidity is the ultimate product, and the U.S. is still the biggest store in the world.
I think we've covered every compartment of this story.
I see what you did there.
I couldn't resist. Thank you for walking us through the mechanics of this. It really turns a headline into a clearer picture of how the machine works.
My pleasure.
And thank you to everyone listening. We hope this gives you a sharper lens on the next dual listing you see hit the tape. Before we sign off, we have to read the fine print.
Please read it carefully.
Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you.
We will see you next time on Breaking News to Trading Moves.